The headlines scream that the market is hitting all-time highs. The anchors on TV are celebrating the rally. But if you take 5 seconds to strip away the surface-level optimism, you see something alarming. Nearly 40% of the S&P 500 isn't participating in the victory lap. It is actually heading for a negative year. We are entering the era of sticky fear. This is a volatility environment where the fear index refuses to settle down, all while the architect of the U.S. economy, Federal Reserve Chair Jay Powell, is scheduled to exit the stage in May. If you are operating your 2026 portfolio using a 2021 playbook, you aren't just taking a risk, you are actively burning capital. This is the portfolio paradox. You wake up, grab your coffee, and open your brokerage app. The pundits are preaching about a resilient economy and robust GDP. Yet, when you look at your screen, your net worth feels like it's trapped in quicksand. You aren't seeing those record-breaking gains. You see red on your tech stocks, stagnation in your index funds, and you're left wondering why the math isn't adding up. You feel that itch, the FOMO, to buy the latest AI dip. But every single time you do, a new headline about geopolitical tension or a sticky inflation report wipes out your progress in 48 hours. You're doing everything the so-called experts told you to do. You diversified, you bought the dip, you held on. But while the market supposedly launches to the moon, your account balance is moving sideways. Why? Because the mechanics of the market have fundamentally shifted, and you're still playing by the old rules. Today, we are tearing down the 2026 financial roadmap. We are going to explain why your current hedging strategy might be dragging you down, why the Federal Reserve is about to change the game for speculators, and exactly how you navigate a year where the market stops rewarding storytellers and starts rewarding auditors. Let's get into it. The first mistake most people make when they encounter this kind of chop is panic buying insurance. When the charts get shaky, the average DIY investor gets scared. Instinctively, you reach for protection. Usually, this looks like buying volatility products, ETNs with tickers like VXX or VIXY. It sounds like a smart, sophisticated move, but here is the harsh reality. These products aren't shields. They are sandcastles in a rising tide. We are currently in a high-floor volatility environment. Simply put, the VIX, the market's fear gauge, is stuck in an elevated range between 15 and 30. It never completely relaxes, but it rarely explodes into total catastrophe. In this specific climate, volatility products suffer from a structural drag that erodes their value relentlessly. You can lose 10% of your investment in these products, even if the market remains completely flat. You think you're buying a life jacket, but you're actually paying a fear tax that bleeds your account dry day after day. Think about it this way. The S&P 500 is projected to gain roughly 14% this year. If you park a chunk of your money in these decaying hedges, that loss eats into your profits so aggressively that you might break even, while your neighbor, who did absolutely nothing, makes double-digit returns. The trap of 2026 isn't the crash. The trap is the cost of trying to predict the crash. To understand why this is happening, we have to look at the 3-year wall. History shows a clear pattern. Whenever the S&P 500 posts 3 consecutive years of gains above 15%, which we just witnessed in 2023, 2024, and 2025, it is followed by a reality check. Sometimes it's a bear market, sometimes it's a grind, but the pattern is undeniable. The market's stamina eventually runs out. The era of easy money is officially dead. Remember 2021? You could throw a dart at a list of stocks, hit a company selling digital pictures of rocks, and make 30%. That only happened because interest rates were zero and the money printer was running hot. That world is gone. We are now facing 3 massive systemic shifts that turn 2026 into a different animal. First, the Fed's exit. Jerome Powell's term expires in May 2026. Markets hate uncertainty, and they hate a power vacuum even more. When the most powerful banker in the world packs up his office, Wall Street gets jittery. Second, the tariff shock. We have already absorbed a 0.5% one-time shock to inflation from tariffs. It wasn't an apocalypse, but it puts a hard floor under prices. Inflation isn't crashing, it's just rising more slowly. And third, the labor flip. For the last 3 years, the Fed was obsessed with killing inflation. Now, their priority has flipped. They are terrified of the labor market breaking. They would rather let inflation run a little hot at 2.7% than see unemployment lines grow. So, what does this mean for you? It means 2026 is the year the market stops acting like a slot machine and starts acting like a balance sheet. Vibes-based investing is over. Now, it's strictly about the numbers. Let's look at the data. We are facing a Goldilocks-ish scenario. GDP growth is projected around 2.5%, and core inflation is hovering around 2.7%. On the surface, that sounds fine, but it presents a major problem for the bulls. Here's the question that should keep you up at night. If the US GDP is growing at a healthy rate, hitting 4.3% in some quarters, why would the Federal Reserve cut interest rates? Wall Street is pricing in cuts because they want the free money back. But if the economy is strong, the Fed has zero incentive to cut aggressively. When the market realizes the stimulus isn't coming, it's going to throw a tantrum. This brings us to the most boring, yet critical concept of the year, the yield curve steepening. I know it sounds dry, but this determines whether you make money or lose it. For the last 2 years, the financial world was upside down. It was more profitable to lend money to the government for 3 months than for 10 years. That is unnatural. It's like a bank paying you more interest on a checking account than a 5-year CD. In 2026, gravity returns. The forecast shows the 3-month yield dropping to 3.12% and the 10-year rising to 3.75%. Why does this matter to your wallet? Because when long-term borrowing gets expensive, speculative companies suffocate. The zombie companies that burn cash and make no profit, the ones that flourished in 2021, cannot survive in this environment. We're already seeing the sector rot. The Magnificent Seven stocks that carried the market on their backs are losing their dominance. The market is widening out, but it's leaving the garbage behind. 40% of the index is struggling, while companies with actual net operating income are growing. So how do you actually make money in this environment? Here is the fundamentals playbook for 2026. Actionable step number 1, bond laddering. Stop trying to be a wizard and time the exact bottom of interest rates. You aren't going to beat the institutional algorithms. Instead, focus on the sweet spot of the curve. We're talking about bonds with 5 to 7 year maturities. As the curve steepens, these bonds offer a solid yield with significantly lower risk than the super long-term stuff. By laddering, buying bonds that mature at different intervals, you constantly free up cash to reinvest at the new market rate. It's not flashy, but in 2026, boring is what builds wealth. Actionable step number 2, the first half pivot. Central banks are shifting from fighting inflation to managing the landing. During the first 6 months of 2026, you want to be overweight in government bonds. Why? Because as yields dip slightly with the Fed's initial moves, the price of those bonds goes up. You capture the capital appreciation. But stay alert. By year end, the 10-year Treasury is expected to rebound above 4%. This is a tactical play for the first half of the year. Actionable step number 3, U.S. over global. I know, everyone tells you to buy emerging markets. Buy Europe, it's cheap. Buy Asia, it's growing. Ignore them. Despite the political noise, the election fallout, and the debt ceiling drama, U.S. stocks are projected to crush their global peers. Why? One word: earnings. European markets are stagnant. Asian markets are facing massive demographic cliffs. The U.S. corporate machine is the only engine generating consistent, high-quality earnings growth. But be a sniper, not a shotgunner. Don't just buy a generic tech ETF. Look for companies with real earnings.
If a company has AI in its name but hasn't made $1 of profit, run the other way.
We want the businesses selling the shovels, not the ones selling the dream. Actionable step number 4, weaponize your cash. You need dry powder. In a high volatility world, cash is not trash. Cash is a strategic position. But don't let it sit in a checking account earning 0.01%. Use tools like SGOV, an ETF that holds 0 to 3-month treasuries. It pays you a yield while keeping your money liquid. You need this liquidity because in a high-floor volatility world, the market will have bad weeks. It will drop 5% or 10% on a scary headline. When that happens, you don't want to be forced to sell. You want to be the predator with the cash ready to buy high-quality assets on sale. While everyone else is panic selling because the VIX hit 25, you are using your reserves to buy the dip on blue-chip compounders like Microsoft or Costco. Here is the summary, and if you take one thing away from this video, make it this: don't trade the fear, trade the fundamentals. 2026 is going to be noisy. We have a changing of the guard at the Federal Reserve, we have tariff implications, we have a yield curve trying to fix itself. The losers in 2026 will be the ones who react to every press conference and every scary headline. The winners will be the ones who ignore the transition noise and focus on one simple fact. Is corporate income trending up? Yes. Is the U.S. economy growing? Yes. The 2026 landscape isn't a cliff, it is a filter. It filters out the gamblers and rewards the strategists. It filters out the people looking for a lottery ticket and rewards the people building a legacy. Stick to the fundamentals, buy quality, keep your powder dry, and let the volatility work for you, not against you. Thanks for watching.